Today's number is 10 because what we just saw in the latest retail sentiment survey reports might have Wall Street salivating like they were in February this year. The bulls are back and the bears have gone extinct. And at the same time, the options market and bonds just started to flash amber. So what exactly is going on as we see volatility kick back in on the metals markets and the world's biggest hedge in the world, the US dollar, starting to drive against the press and sentiment? Well, guys, join us today as we cover off what exactly is going on in the wonderful world of markets. And boy, oh boy, were there some big revelations over the last 24 hours. See you soon. This is going to be a great one. Well, welcome back, everybody, to The Daily Show. My name's Thomas Atkinson. It's great to have you here. And of course, today we'll be going through the macro, the data, and of course, the key flows that you need to be watching in these markets right now. We'll kick things off by having a look at some of the latest sentiment survey results, some of the dark pool activity, and of course, the data for October. And then we'll go into the options and the levels that we need to be watching. But first up, this latest sentiment result finally showed us what we've been looking for a while. And it wasn't really the change in the bulls so much, it was the change in the bears. People have finally given up on trying to short this market. And you guys know, as a bit of a contrarian, this is a very interesting point because not only have markets started to flash a little bit of overboughtness again, but they're doing it at a time when, of course, volatility can come back in. So will Wall Street actually pounce on this? Well, one thing's for sure is there's not too many people that are neutral. In fact, neutrality in the market sentiment survey reports is at pretty much historic lows. But at the same time, you can see here, bullishness increased, bearishness decreased, and this is usually what Wall Street likes to do. When you get a sentiment survey spread that's getting up there in the 10% marker, you're basically entering into that peak kind of complacency. And we saw this during last year several times, including just before the August sell. And of course, we saw it this year in January and February. Now, could it cause another pullback once again? It's certainly one of those lead contrarian indicators and something we need to be watching. But maybe more interesting than any of this is the rolling 1 month estimated retail demand. Because according to the latest data results, Morgan Stanley have just shown, courtesy of Marlin Capital here, that we just had the largest ever inflows from retail with $100 billion of US stocks being bought in just 1 month alone. And of course, this last happened, yep, you guessed it, in February of this year. So why is this all so important? Well, it all has to do with stock picking. This market is not as correlated as many people think. And in fact, if you've been a stock picker this year, you've been doing very well. We've talked about semiconductors here, metals, and other sectors, and they have absolutely made up the lion's share of the gains. So as Goldman Sachs says right here, it's a market similar to what we actually had in 2018. And why this is important is because during 2018, we had two big sell-offs. Of course, the kind of trade war with China at the end of the year and Volmageddon, that classic volatility that started to come through. And one thing that people have been looking for a while is an excuse or a reason to say, oh, look, zero DTE options have caused volatility. Now, we've been looking for that for years and no one has ever seen it yet. So could this be the time? Well, one of the good bits of news is that this may just be a blip on the horizon, even if it should occur. If you take a look at all of the kind of bear market into bull runs, such as what we've seen here since April, it's following a very similar Zweig breadth thrust, which tends to be a bit more consolidated around this time, but does tend to actually rally into the end of the year. And we've already detailed on this channel over the last couple of videos, and I'd suggest you go and have a look at those if you're interested, that November has some amazing stats with it. Even if we see a sell or volatility come into October, it's likely to be bought up by the street. So the real question is, if we do see vol, how much lower could it go? Well, in many ways, it's probably going to come back to the bonds market. And while this is an older chart here, we'll look at the new one a little bit later on, you guys can see that it's kind of very complacent. In fact, it's been complacent ever since April, and it's continued on its downward track, which of course is very bullish for markets. But that started to spike over the last 24 hours, and of course, it's something we do track here along with the price action itself. The semiconductor market is also incredibly overbought, and while it still looks bullish on the charts for now, we have seen a couple of large dark pool activities come through in recent days. And this is something that we do track because, of course, when Wall Street makes a big move, we want to be paying attention. And while it might not be the end of the great run, what it can do is be a topping point temporarily for markets. So the consideration we have is it due? Well, in some ways it is. At around 117 days, you can see here a few markets have seen NASDAQ volatility come back in. This one's here courtesy of Blue Curtic. And what it shows us, guys, is it shows us basically that we have not seen almost any volatility during this epic run. Classic signs of a pretty strong market underneath. But when volatility does come in, you would usually expect, of course, at least a 2% daily move in the NASDAQ and something maybe even a little bit bigger. And why is that? Well, it all has to do with Wall Street wanting to compress and attack, more importantly, leverage that is in the system. We do know that just over, 48 hours ago, we saw that I think a new ETF fund was going to produce like 59 new triple leverage long ETFs, and they're all due in December. So what that means is there's huge appetite for leverage in a different way than we've seen before. And of course, who is taking a lot of that? Yes, you guessed it, us as retail traders. So as we set up into this earnings season, the question then becomes, will it live up to Wall Street's lofty expectations? They already plan on seeing this in terms of the EPS. And of course, it's expected that the stock market is going to completely outpace the economy as the Federal Reserve and indeed the government is going to be needing to force to stimulate the economy, while at the same time, these stocks will benefit from AI being able to potentially lower their workforce and all other different things. It's also important to note that some of the numbers have changed this year. In fact, we've been talking about this for a little while, but it's expected that now with the jobs numbers, the US economy needs approximately around 30,000 new jobs per month to actually be running at a net even. So that's gone down from extremely high numbers only a couple of years ago. And this is, of course, due to the immigration changes that have been going on. So when you see the number, if it's low and you're worried about it and the market's going off into the sun, it's because in many ways that we now have a new, different version of what it should be. The other thing as well is even if the market comes in and we get these jobs numbers, let's say next month, because of course government shutdown, the other problem is that even if it's bad, the market will just say, hey, Federal Reserve, we need more cuts. And of course, they may actually get it. So the thing about this market is that it is quite euphoric. It is quite FOMO, and it is running in what I believe will ultimately be called a bubble. But remember, bubbles can last longer than you can remain solvent. And some of the best gains often do happen near the end of bubbles. So it's always important to note that when people call it a bubble, it ain't usually the end. And we've seen a lot of sentiment surveys showing that. In fact, August was the #1 search record ever in history on Google as of tracking, which is obviously going back to 2004, for the market being in a bubble, which usually means that it's kind of now going past that point to people just saying, oh, who cares? I won't be caught with it, guys. That's what everyone always thinks, the famous last words. So with the story of dollar debasement becoming probably one of the most popular topics online, which you could see here clearly, what we've actually witnessed in markets is that precious metals have become one of the best trades. Now, if you've been watching this channel for a while, you would know that I'm a huge fan of precious metals, and I do think that they make up a huge part of the future of markets, particularly because of AI and also just geopolitical tensions and de-globalization. Everyone's starting to realize actually a few people have way too many rare earths in particular, and rare earths have been going absolutely ballistic this year. Well, palladium seasonality could be coming. We've shown that on the charts, and you can see here, it just looks like it could be the beginning of a base. But what did happen over the last 24 hours is we started to see volatility in both gold, silver, and other metals, particularly in gold, selling almost 3% off in the session. And you might say, well, is this the beginning of the end for gold? In my opinion, no. But at the same time, could it be an extreme volatility case and maybe a good opportunity? Well, fortune favors the brave, but also fortune favors sometimes the patient. And in this case, I think patience, react, don't predict, might be the best case here at around 4,000 for gold. But it also came into silver. And you can see here, as we've done this ratio a few times, you'll notice here the Tavi Costa chart basically shows that silver is still relatively cheap when valuing it to gold. And this is pretty important because Blue Curtic just put out another one. Met up with him actually this week, and it was pretty good to see him. So this was silver has been above its 200-day moving average for 126 days. So that's pretty good. This is the 11th best streak in 25 years. Obviously not quite up there with gold yet. As we know, silver's a little bit undervalued to gold still. And you might think, well, this means that it's on such a big streak, it's going to crash. Well, actually, in 9 of the last 10 cases, 12 months later, silver was up. And some of these gains were epic. Now, this one sucks, but let's be real, 89%. Wow, that would be wild. I don't think we're going with something like this, but it is interesting to see here that the numbers are very positive towards one of our favorite metals. And yeah, it may actually outpace and beat the index over the next year. So do you guys think the precious metals are going to beat the S&P? Let me know in the comments down below. Another interesting fact that we kind of skimmed over yesterday was one of the sectors we saw thrust up about a week ago was healthcare. We saw insiders obviously buying it for a while. It started to do some technical analysis levels and break through. And so far, it's been holding up very well. Now, if the market is to sell here, remember, this is a partially defensive sector. So sometimes it can hold dollar for dollar better than the S&P or NASDAQ if they do drop. Another big story has been, will we see reinflation? Now, of course, this is a concern. A lot of people in macro always bring it up and say, oh, the reinflation. And of course, everyone's been saying that for ages. The thing is, the market won't care till it cares. So what I think it's telling us is that the commodities market is kind of like that almost hedge against a lot of things. If we do see stagflation, it may do well. If we see AI absolutely pull off and we make Terminators everywhere, then probably metals will do well. And of course, if we go into deglobalization and everyone they're fighting for basically being the fittest and the best, then it's probably going to do well. So you can kind of see here that commodities look pretty good, but also they've got a warning sign here when you compare them to the US 10-year that maybe inflation's back and the market's sniffing it out before everybody sees it in the press. The other thing is going to be structure of the markets. We're about, 1 month in now post rate cut, and basically the markets have been going kind of up. And you might say, well, that's good. It's good as long as it doesn't kind of follow, this orange line. So of course we don't want to follow the orange line if you don't want a recession. And we also want to know what sectors are going up the best. So of course we'll be tracking that here. So make sure to continue to follow the channel. And we'll be on that top of that one for the next 1 to 6 months, just like we were last year when we used the same idea. And it, of course, told us unlikely to see a recession at that point. Now, if we have a look here at Wayne's latest data using the latest information that we have going into October, he found that October 20th to 27th were the most likely kind of sell points. And we're actually only about 10 days away from that right now. So again, in terms of weakness, it's usually more at the back end of the month. So how is October going so far? It's kind of like that. Where's the weakness? Generally at the end, if it's going to be there, and it leads into November, which should be, theoretically, even if we see sells, a positive month. So let's have a look now at what we're seeing in the markets. First up, we're seeing a little bit of bullishness here, and the market is, of course, continuing to be dull, continuing to drive up. There's no real reason to say this is going to sell off tomorrow or anything like that, though it has printed a little bit of overbought action here. And you can see that if the market does close above the last day's high, I think it would probably squeeze for a couple of similar sessions, similar to over here on the left-hand side. Now, if we do pull back, where is the buy zone? A lot of people are going to be looking at the daily 20 as the key level. It's been an amazing level all the way up. So, of course, that's going to be a very interesting point, and we'll have to be watching it very closely because remember, while the market's starting to show a little bit of volatility, it's not this one that actually is most worrying. It's probably the bonds market, which we'll look at very soon. When we go and have a look at the futures, clearly a few people are starting to stack some puts, and that's not necessarily been a good thing in the past. In fact, stacking puts has often led to the markets rallying up. But we do have a couple of key levels to be watching. 67.50 close above, plus that high that we saw on the S&P. If we get that, then we're probably pushing positive gamma. 68 plus, that kind of thing, maybe even 7K. And we also have quite a lot of puts starting to sit at 6,700. So basically this market is kind of neutral where it's sitting right now. Because it's slowed, it's gone from being super positive gamma to more of a hedged market, and it's waiting for its next big direction change. And of course, then we have Tesla, which is still showing a 430 put and 450 on the call, which makes no difference from where we were 24 hours ago. And then we have NVIDIA, which continues to be relatively strong, but at the same time, you can see here that 195 core wall, which could make this stock go absolutely ballistic if it does go through that level. Now on to Bitcoin and gold. Now Bitcoin has been kind of playing with this $70 for a while. I'm not too concerned about Bitcoin because I think it chilling would be fine by me. And you'll see on the charts that it's kind of doing this after that big resurgence to all-time highs. Now, I'm not too bearish on Bitcoin because even if it does pull back, I think the current government policy, which is now the most important thing, if you can believe it, for the cryptoverse, may come into play, particularly at the end of this month when we see all those exchange-traded funds potentially get green lit. Now, if that does happen, of course, that could be a good story. And then all of a sudden, if Bitcoin is kind of sitting around or even declining a little bit, it may send a little bit of a rocket ship underneath it. Remember, crypto markets don't tend to end without euphoria. And it's pretty normal to usually see in euphoria all the crappy alts to also go as well. And they have not done that pretty much this year. Let's have a look at gold. It is certainly a little bit different. Looks like a Christmas tree with red baubles on it now. So we have a lot of different strikes coming through here. And you can notice that we're not as bullish as we were just a few days ago. Suddenly puts came out of nowhere. Yes, there's still calls. Yes, the market is, of course, rallying over, months and years. If you're thinking about it from the gold perspective, that's at least what the macro would tell us. But clearly a zone has been found. And you can see that kind of represented here by this very confusing amount of call walls and puts. And somebody stacked a whole bunch of 370 puts as well. So clearly there's something afoot and volatility came in. You guys know that I like dull, boring markets if you want to be super bullish. When vol comes back in, it's one of my first early warning signs to say, did it hit one of our targets? Should we be looking at just chilling for a little while on new entries? And maybe we're going to get a pit, which is a pullback in time, or maybe even a better opportunity. It could be coming faster than we think. Let's now have a look here at what's going on in the bonds market. You can see here it's spiking back up a little bit. You've got a little bit of weakness here in the trend line, but really I think it's going to need to break above a 2.91 ratio for us to actually even see proper risk off in these markets. US oil was down, but still holding up. This is definitely speculative right now. And as we've said, if oil starts to really push through as well, that could actually show us that inflation really is back. It tends to be one of those commodities that really does drive yields in particular. So it'll show us that the market's starting to sniff something out that they think is troublesome. Oil services didn't really have a great 24 hours. Again, it's kind of coiled around this point. And platinum went ballistic again, which is something that we discussed here. Obviously, we did discuss in our private community. Links in the description down below if you want to join that. And that was something that we saw kind of show up with great replicable technical analysis. But at the same time, then it rallied through and it did one of those big sessions. I mean, this thing's just been going very, very well now for only a few months. And I think what it shows us is abundance is there. But if we have a look out and we zoom out a little bit here on the weekly, and you've got, we don't even have that. We don't have enough here on this one. Let's get the other feed up. And what we can see is that we're going to be getting into, yes, that supply, that resistance over here on the left-hand side. And this is clearly a point where you would expect some people to be taking some profits on things like platinum. And you're also seeing the same thing in palladium. So if we have a look at palladium, while it's behind the others, again, hitting into that kind of zone up here, that 1500, which we had in our last video. And why? Because it's just had that really big resurgence, and that type of volatility, when that comes in, often it can mean that we're starting to get kind of near a point where it needs to consolidate once again. That was a thrust. We saw it all the way through the internet. Suddenly it's trending everywhere. When everything's trending, might be a couple more sessions in it, and then tends to be pretty bad. Healthcare's taken a chill. Nothing really wrong with that on the charts at this point. And the dollar has gone up. And as we thought for the last couple of sessions, it's been probably one of the better trades in the markets. Why? Well, it's against everyone's opinion. And why is that important? Well, it's good technical analysis. And of course, if we've got good flow, we've got an oversaturated press, which is saying that the dollar is dead and everyone should run for the hills. While that could be correct over the longer term, of course, when it becomes the most well-known story, then you have to get, of course, that price action going the opposite way just to stuff everyone over. Now, where could it go to? 99.80 is definitely a target in the technical side, so certainly something we're watching. And it kind of comes back to also looking at gold. This thing has gone ballistic. I mean, it hit that 4,000 target, which was awesome, but this is actually quite a large volatility day, 2.84%. And why that's important is it went from 4,000, let's say 60, all the way down to 3,940. So it's over $100 of movement there to the downside. You might say, well, that means nothing. Well, it means something because once you get on these kind of volatility periods, often you do have problems. This is the largest transaction size bearish that we've seen. Look at the volume as well that we've seen in this entire run up. So someone probably did take some profit, something we need to watch. And of course, in the short term could bring in some consolidation. I wouldn't short the damn thing, but what I am saying is that I think it could bring consolidation or even pullback. Silver did something similar, cracked 50. I can't believe it. That was really quick. And while I do think it's still cheap in some ways, this is a monumental day for silver. I mean, this is obviously history. So we've made history, amazing times. But at the same point, is it dull? Yes. Is this a bit volatile? Absolutely. It dropped like literally $2 an ounce pretty much throughout the session. So that is a huge movement. And if we're going to break that down as a percentage, it is a 5% switch in a day. So that's, of course, volatility entering back into the market. Tesla, it's kind of boring on the charts. 420, 430 is the put support. So that's kind of where the buyers are. 455 is actually where we think the call buyers could come through and start squeezing it up. So it's fine, just having a bit of a breather up the top. And another one that, of course, everyone's looking at is NVIDIA, which is doing pretty well. And as we've suggested, it looks like these semiconductors, particularly NVIDIA, has broken up. And obviously, it's getting a lot of love in the markets at this stage. Magnificent Seven stocks do not seem to be selling off just yet. They're obviously in a coil. So that's something we're watching very closely here on the charts. And in terms of everything else that we're looking at, the US 2K, the Russell, the NASDAQ, all of those, they're all still basically just kind of piling higher at this point. Although I would say also with the NASDAQ, similar to the S&P, it's kind of hit that point where if it goes through 25,200 plus closes, it signals that it may squeeze for a few sessions and then maybe have a problem. But for now, it is actually at a slight overbuy in these markets. So it's certainly time to be like, well, wait a second, it's not as good as it was just a few days ago, because what's happened is the dynamics are starting to shift a little bit to slight euphoria, if not a little bit more than slight euphoria. On Bitcoin, sideways, it's just chilling, it's doing a pit, round all-time highs. So nothing really going on here. The longer it sits and coils, especially if it coils tight, the better the trade's going to be coming off that. So congrats if you got the good rally. But for now, we're just basically waiting for the next piece of information. If you enjoyed today's video, guys, please remember to subscribe and smash that like button. We do this every day, and obviously we bring you the best, fastest content from across the world in all of the major markets. And one of the things, I guess, in terms of the summary for today is that while we have seen, of course, a euphoric rate market, and it does look like the buyer demand is probably going to be underneath the hood, things changed. And what I mean by things changed is that we saw volatility come back in. We started to see a little bit of what looks like some sneaky targets taking profit. And more importantly, it looks like euphoria and the bulls are back. And remember, it's been a wall of worry the entire way up through these most volatile months, which are generally August, September, October. This is the first time we've actually seen a result come in that shows something different. Have a great day. We'll catch you in the next one. Bye for now.